Hello, this is Stock Watch with Chris Pedersen on Wednesday, the 19th of July, 2023. Any advice provided is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Inflation update. Past couple of years, inflation's been a hot topic. According to the RBA, May inflation was only 5.6%. On an annual basis. RBA target is 2% to 3%. Lower interest rates make equities more attractive versus bonds. Here's a chart on inflation historically. You go back to the late 1980s and look how high it was. And then it all trended downwards and was steady, and then it soared recently. So obviously, that would have had a big impact on investments. Now, when we look at RBA and their forward projections overlaid with UBS estimates, what we see is we had a peak and now we're trending down. This is all very good news. On a global inflation basis, this chart is fascinating. You can look at it as your leisure, but one important thing is the United States inflation rate has plummeted from its peak. What is good for the US tends to be good for Australia. Here is the ASX 200. This is a 3-year chart. What is amazing about this chart and why I'm showing you is that during this peak in inflation, the ASX 200 sold off a little bit, but it was not dramatic. We have a lot of confidence in the RBA and them being able to attack and solve the inflation problem. This week I'm going to focus on the iron ore sector. Today we had the first production update with Rio and it was at 8:30 this morning. BHP is next cab off the rank on the 20th of July, also at 8:30 in the morning. Then we have Fortescue on the 27th, and Deterra Royalties is a byproduct of BHP. That's going to be the 20th of July, and then they will digest the information and report their own numbers around the 31st of July or 1st of August. Other minor updates, which are just for your information, you can look at this slide at any time you want. Iron ore price estimates looking forward. This is US dollars per ton and China's 62% grade. For the year 2023, what we have is the first quarter, the average price was $125 a ton. Second quarter goes down to $111, and by the end of this year, it's estimated to be at $95 per ton. Now in 2024, the first half is expected to average around $100. The second half of next year is estimated to be around $83. Then we have 2025 for the year, an average of $91. 2026, UBS is estimating $76, and 2027, $75. So what this is telling us is that analysts are expecting the price of iron ore to decline moving forward. Looking at BHP Group, closed last night at $44.82. Here's a chart on its performance over the past 3 years, but let's look at the fundamental numbers. Again, all of these numbers today are UBS estimates. Interesting, BHP has a beta of only 0.84, which means it is less volatile than the market as a whole. As a cyclical company, in something like iron ore, you would expect it to have a higher beta. Well, that may be in the future, but past 5 years it's been low. The market cap for BHP is $227 billion. The 12-month price target is only $37. They rated a sell. The revenue growth rate from 2023 to 2025 is estimated at negative 3% per annum. With a decline in iron ore prices, that decline in revenue is not as large as we would expect. Earnings per share growth during that same period is expected to decline 20% per annum, with a dividend growth rate decline of 18% per annum. Now let's look at the PE ratio. This is typically off of the 1-year forward earnings per share. So that is 2024 estimate, which is $2.29. This is a PE of 19.6 times. For a mining company that's cyclical, that's a very high PE. The yield off of next year's dividend of $1.38 is only 3.1%. The free cash flow is less than 6%. from 2022 going out to 2025, the payout ratio is only 60%. Buying BHP is making a bet that the analysts are all wrong on the future of iron ore price. The payout ratio, I think, is attractive at only 60% because it gives management the ability to raise that payout ratio to increase the yield to keep the stock price up. Next iron ore company is Rio Tinto. The code is RIO on the ASX, and last night it closed at $116.88. This is a 3-year chart. You can see it's been trending sideways. Let's look at the numbers. These are UBS estimates. The beta on Rio Tinto is also less volatile than the market as a whole at 0.71. The market cap is $191 billion. 12-month price target is $95. It's a sell. The revenue growth rate from 2023 to 2025 is a negative 4% per annum. The earnings per share growth during this period is negative 7%, and the dividend growth is also negative 7%. The PE ratio on Rio off of 2024 earnings estimate of $6.17 is 19 times, whereas the yield on the 2024 dividend estimate of $4.33 is 3.7%. Free cash flow is around 6.6%, and the payout ratio, like BHP, is only 60%. Global supply is satisfying demand. If economies, including China, remain strong, then iron ore price will not drop as expected. Fortescue Minerals, FMG, closed last night at $22.71. So the company also for the past 3 years has been sideways. Looking at these numbers, we see the beta of 0.97. Well, this is in line with volatility of the overall market. Market cap is $70 billion. 12-month price target is $17.10. UBS has it as a sell also. Revenue growth rate during the 2023 to 2025 period is estimated at negative 11% per annum, whereas the earnings growth during this period is estimated negative 28% per annum, and the dividend growth negative 36% per annum. These are all pretty atrocious numbers. The PE on next year's earnings estimate of $1.57 is 14.5 times. Traditionally, 14.5 is a high PE for a miner. The yield on next year's dividend estimate of $1.16 is 5.1%. However, that's not the whole story. The estimate dividend for 2025 is significantly lower. The free cash flow is 9% now, dropping down to 3% by 2025. Also, the payout ratio now is 63%, and that's declining to 50%. Fortescue's greater risk to downside than BHP and Rio. Again, it's a bet on global economies and no recession. The fourth company covered today is Deterra Royalties. On the ASX, it trades under DRR, and last night it closed at $4.72. Let me describe this company briefly. They don't actually mine anything. It's just royalties they receive from BHP. The beta on the stock price is 0.86%, and it has a very small market cap, only like $2 billion. 12-month price target UBS has is $4.10, also a sell. The revenue growth rate for each of the next 3 years is negative 9.6%, and the earnings growth from 2023 down to 2025 is estimated negative 9%, and the dividend growth rate is expected to fall 10% per year. The PE on Deterra's 2024 earnings estimate of 28 cents is 17 times. The yield on the 2024 dividend, also 28 cents, is 5.9%. This is attractive and why people buy the company. The dividend this year is 30 cents and it's falling down to 24 cents by 2025, whereas the payout ratio remains steady at around 99.5%. They don't really have many expenses. It's a good stock yield and it's tied to iron ore price and interest rates. This chart on iron ore supply and demand tells you everything you need to know about iron ore now and going into the future. This tells you the amount of supply less the amount of import demand. In 2022, there is 67 million tons of excess supply, and this increases globally to 101 million tons this year, and next year it's estimated to go up to 200 million tons excess supply, and in 2025 it only increases. So basic economics, Blind Freddy can tell you that when you have excess supply, the prices go down. As always, if you want to learn more about anything I covered today, send an email request to stockwatch@fnn.com.au and direct your email question to me, Chris Pedersen. I hope you have a wonderful and profitable week. Thank you.